Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee. Joining me are my co-host, CoinDesk Managing Editor of Global Capital Markets, Lawrence Lewitton, as well as Managing Director of International Content, Emily Parker. Good morning, Emily and Lawrence.
Good morning.
Yeah, we're seeing Bitcoin, well, trading pretty flat. Let's have a live look at the CoinDesk Bitcoin price. XBX index currently trading at $68,089 or so dollars. Now up about 15 basis points over the past 24 hours. And the CoinDesk Ether price ETX index is at above 4,800, but trading pretty flat. And the new DFX CoinDesk DeFi index is at 665 points. DeFi taking a pause, bit of a retreat at 1.6% below the past 24 hours. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto news, events, and data. So it appears that the crypto markets are taking a bit of a pause, Lawrence. I mean, there was some optimism that in Asia trading hours that it might see a bounce, but that didn't really happen.
It didn't happen, but hey, look, you just said earlier, Bitcoin's trading at 68,000. ETH is at 4,800. I mean, we weren't thinking about these numbers several months ago. This is like, if we step back for a second, we think about it, it's a rally of Tom Lee proportions. This is you're going to have days like this where there's a breather. You're going to have 1% up, 1% down. As people go, okay, now what's the next move? You might see some churn for the next few days, for all we know. And there seems to be some decline, at least on the futures exchanges, as Omkar Gadboli was reporting today, that there's some decline in the amount of futures contracts that are being taken in the CME. Nonetheless, 68,000. You can't just say that number and think, oh, okay, this is terrible. It should be 70,000. 68 is pretty good for
yeah.
Bitcoin.
The crypto markets have been having a breathtaking run, a bit of profit taking happening this morning. Taking a look at Coinbase earnings, which were released just after the closing bell yesterday, weren't so great, right, Emily? I'm seeing that in the pre-market, Coinbase stock is trading is down 8%.
Yeah, so Coinbase shares fell. The revenue was less than expected. Expectations were really high. Again, this was Q3, so that's kind of a different situation than now. But yeah, I mean, there's been such high expectations for Coinbase. So I guess like some element of disappointment at some point was inevitable.
All right, well, let's take a look at our sponsored guest.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
As crypto grows to trillions of dollars in market cap, it's become increasingly impossible to ignore by governments and financial watchdogs alike, which are looking to regulate the industry. The Biden administration's report on stablecoins urges Congress to regulate stablecoin issuers like banks and leaves open further proposals around aspects of the crypto market, such as decentralized finance. Joining us now to discuss is Rune Christensen, founder of MakerDAO, a decentralized credit platform on Ethereum that supports the DAI stablecoin. Hi there, Rune. Thanks for joining us. So I wonder if you could share with us some of your key takeaways on how the U.S. is trying to regulate stablecoins with this report. How will it affect the DAI stablecoin and how stablecoins operate in decentralized finance?
Yeah, so regulation is really fundamental to stablecoins, of course, because stablecoins and both centralized stablecoins and decentralized stablecoins, like the DAI stablecoin alike, really care about hedging their collateral with the solid assets. So having a positive regulatory environment, of course, that really determines where you want to put that hedge. I think that actually this presidential working group report that just came out is one of the really big milestone in stablecoin regulation, and I think it's incredibly positive because it shows that the regulators are thoughtful enough to, first of all, distinguish between centralized stablecoins and decentralized stablecoins, right? So you have it in footnote 5 in this report, which is important part, basically, that spells out that this is for centralized stablecoins, right? And setting aside basically decentralized stablecoins as something that is fundamentally different because they're decentralized, right? And the fact that they're thoughtful enough to do this actually bodes really well, I think, for sort of the future regulatory climate in the US. Because I think it shows that the potential value of decentralized technology is being recognized, right? It's not just being sort of lumped into the same box and without really sort of caring about how that could squash innovation. For MakerDAO specifically, I actually think this could result in Maker feeling more comfortable allocating more collateral towards the US economy in the same way we've already done with things like doing short-term mortgages in New England and considering solar projects in Long Island and these kind of things. So overall, this has really turned me very positive on the outlook in the US.
So, Rune, exactly what kind of regulation do you think should be in place for something like decentralized like DAI, or should there be none at all? I mean, what's your ideal situation? Granted, it's always deregulation for a lot of people, but and how do you see it? What would you like to see done that would help the situation?
Yeah, I think we need thoughtful and good regulation. I think that sort of expecting a kind of Wild West deregulation isn't necessarily good because it doesn't necessarily create certainty, because then you can have sort of situations that then cause a sort of backlash and overly strict regulation, right? So it's really a matter of striking that balance where the good regulators can interact with sort of the good, legitimate, decentralized projects to figure out the right approach, because it's a difficult topic ultimately, because the decentralized nature of decentralized protocols. What that means is there's no legal entity to regulate directly, right? You have to sort of regulate on many different fronts, all the different pieces you can access, and basically that it is going to be more complicated to do than this approach to centralized stablecoins.
Do you think that the actions of certain centralized stablecoins have made it more difficult in general for the entire concept of stablecoins, and that it's prompted the need for heavy regulation, potentially, particularly of centralized stablecoins? Do you think that perhaps the centralized stablecoins maybe went a little too far with what they're doing?
I think that USDC, Paxos, USDP, like these more recent, like more established stablecoins that are working out of the US, I think they actually set the bar pretty high, and that's why Maker uses these two stablecoins specifically for liquidity of the DAI stablecoin, exactly because we think they seem to have a good grasp of sort of their self-regulation. But of course, when if even more sort of thorough regulation is applied to them, that's actually a benefit for us that we're happy to see as well. I think all in all, this final outcome, it seems. Of course, I'm talking from a perspective of someone that's working on a decentralized stablecoin, so it ultimately doesn't apply to us. But as a user, both personally and from the perspective of Maker, I think it's really good to have very strong clarity on what are the assets backing these stablecoins, right? Because it's not like in DeFi where you can just look at the blockchain and see what's the collateral for this, right? It's instead you need regulation to provide that clarity and trust.
Rune, it's really interesting to hear your comments. You and I spoke before this stablecoin report came out, and you had a pretty different perspective then. You were sort of warning about stablecoin regulation in the US and how it could potentially be disastrous, right? So just, beforehand, just rolling back a little bit, what were some of the concerns? Like, what were you so afraid would happen in the US that would be so bad for the stablecoin industry? Because, you've been warning that if US regulators made the wrong moves, then DeFi could potentially move out of the US. So could you just spell out for us some of the concerns that you had and what you and are those fears basically allayed by the report?
Yeah, I think the number one thing that sort of the legitimate DeFi projects, the sort of the large established DeFi projects, what they're worried about in terms of regulation is basically regulators failing to see the advantages that DeFi can provide to the world, right? So they, instead of seeing it as something that can, a new type of innovation that can help everyone, see it more as something to crack down on, like they do in China, right? And so that's the thing. I mean, this new report, it very clearly shows a recognition that there's a difference between centralized stablecoins and decentralized stablecoins. And there's a good reason to hold off from regulating the decentralized projects until there's sufficient knowledge to regulate them properly. So basically, I mean, yeah, like I said, I think this is a huge moment in the stablecoin regulation, this report specifically.
I understand that MakerDAO has now become fully decentralized. Can you explain and walk us through what that means compared to other platforms that may still have centralized aspects to them? Tell us, what is the path toward true decentralization versus other DAOs that claim to be decentralized but may still have some centralized aspects?
Yeah, I mean, of course, it's all a spectrum, and you can't sort of define it black and white. But the thing that MakerDAO has achieved is it went from being built by a centralized, legal entity called the Maker Foundation that sort of bootstrapped the community. It wrote all the code, it launched and deployed the protocol. And then as the protocol was deployed and started growing and started earning income, the protocol itself, through its decentralized governance community, began actually funding its own contributors, essentially, right? So the protocol began directly on the blockchain to pay, began paying people to do things like smart contract security and risk assessment. And then as that increasingly was done by the protocol, the foundation basically became obsolete and had no more work left to do. And then it shut down and it's dissolving. And it's the very last stage of legally dissolving. But I was the CEO of the foundation, but I left that role a couple of months back because there was nothing left to do.
So, one thing that you mentioned is that in a piece recently, you said that you'd like to see things move to the Ethereum blockchain, everything move back to there. If it's decentralized, first of all, how is that possible? Second of all, the idea is that it's because it's a proof of stake model and you have environmental concerns for some of the other platforms. So can you elaborate on that a little bit?
Yeah, so specifically what I'm concerned about in this question of Ethereum versus other L1s, as they're called, is if you look at, today you have a lot of crypto projects that build across all these different L1s, all these different sort of Ethereum competitors and Ethereum itself. And the problem is when you transfer asset across two blockchains like this, you have to go through what's called a bridge. And these bridges are basically all like centralized or multi-sigs, essentially. So it's a big issue that that's not really, I don't think it's made clear to the user that when you do this, where you use multiple blockchains at once, today the solutions that are available effectively make the protocol you're using completely centralized and actually expose you to quite a lot of risk that wouldn't exist if things were more tightly connected, such as in the Ethereum ecosystem with these things called L2s, right? Rollups that make sure that when you do move from one blockchain to another, you preserve security and decentralization.
So, Rune, one of the reasons that you've taken such an interest in U.S. stablecoin regulation is that you've sort of said in the past that the U.S. is kind of the primary player in DeFi. Can you just explain a little bit why you hold that view?
I actually think that it's more like that the US is the primary beneficiary of DeFi, essentially. And this is because, well, it's almost not really, it's not really acknowledged quite often, I think, but all of DeFi runs on USD stablecoins, right? There's just no other, there's barely any other type of stablecoin than USD denominated stablecoins. And this directly results already today in hundreds of billions of capital inflows to the U.S. economy as these stablecoins need to hedge their exposure, right? And I think today it's probably it's primarily things like treasury bills in particular, right, which helps by reducing the interest costs of the federal government, which is great. as well as corporate debt, which basically helps corporate America and potentially creates growth and jobs. And then you also have a decentralized stablecoin like Maker that is looking to these more sort of direct real-world asset collateral allocations, where we do things like funding short-term mortgages, like small businesses with directly funding small businesses, and also this solar projects in the US.
Rune, do you still believe that Ethereum is the best blockchain to do this on? A lot of folks are complaining about the fees, the lag, and there are other blockchains out there that do smart contracts.
Yeah, absolutely. I mean, I think that not only is Ethereum sort of the first mover, it has all the network effect, but I actually also think it has the best technology because it has taken this modular approach to blockchain, right? So what that means is that the Ethereum mainnet basically functions as a settlement layer, and then you have all these roll-ups and L2 blockchains is basically that can provide the scalability. And so today we only really have like sort of the major rollups. We have Optimism and Arbitrum that follows this optimistic rollup approach, which already works quite well and has reduced fees quite a bit. But the next phase is what I'm really bullish on, and that's gonna I think perform better than really anything else that can be provided, anything else, and that's the zero knowledge rollups. We've already got projects like DYDX, which I think is like the top derivatives exchange now, and it's powered by zero knowledge rollups. It just has better performance than anything else you can do anywhere else, and remain decentralized. And what's going to be really exciting is when we get these fully programmable, composable zero knowledge rollups, so we can really see what something like DeFi looks like when there's basically zero fees.
Yeah, it is exciting to watch the developments. Rune, thank you for joining us. An incredible, ambitious project you're a part of. Thank you. That was MakerDAO founder Rune Christensen. Coming up, we'll have a crypto markets update with Forex trading firm Oanda.
When we say we want to reimagine money, it turns out we're going to the heart of the matter. Imagination has always been a key part of what money is. Imagination, in the form of cultural creativity, is also something that the cryptocurrency community has in spades. And to the outsider, that can be a reason to dismiss it as frivolous, as something built on nothing. To dismiss it for these reasons, though, is to ignore that all money is imagined.
The Crypto Markets Update is presented by Grayscale, the world's largest digital currency asset manager.
Well, the crypto markets are perking up with the beginning of the North American trading day. Checking in on Bitcoin, the CoinDesk Bitcoin price XBX index is trading at $68,661, up about 1% over the past 24 hours. And the CoinDesk Ether price ETX index is at 48.44. ETH is up about 0.8%, and the new DFX CoinDesk's DeFi index is trading at 668 points, though taking a bit of a retreat at down 1.2%. Joining us now to discuss the crypto markets is Edward Moya, Senior Market Analyst at Oanda. Hello there, Edward. Thanks for joining us. So, taking a look at Bitcoin and the crypto markets, a very incredible all-time high run these past few days. But now we're taking a bit of it's going pretty flat. Do you see it range-bound in the short term or further break a ways ahead?
Well, I think right now the market is right now having a major reset, and I think you have to take a look at what happened last week. And when Wall Street was positioning how to invest for the rest of the year, there was this belief that you needed inflation hedges. And I think a lot of investors thought, though, we were going to start to see inflation peak. And for much of the active money that is new to Bitcoin, you saw some hesitancy that we could be at a near top. And this morning we got a very hot inflation report. Inflation's at a 30-year high. The risks that the Fed is making a policy mistake are growing, and you're probably going to see, I think, further momentum in the short term. I think you should probably see a test at some point this week above 70,000, but I think it'll be a little bit difficult to break much further from there. I think you'll probably see a consolidation between 65 and possibly 75,000 until year end. And I think as inflation worries grow, that will actually become a negative for Bitcoin, because what's going to happen is you're going to be approaching year end, and all of Wall Street wants to show that they were profitable in trading cryptos. And with Bitcoin up over 120%, Ethereum up over 550, I think, you're probably going to see some decent profit taking. So I think that is going to be a big risk that you're going to have in the short term. But the bigger story is inflation. If we get a few more months of hot inflation reports, you're going to see, I think, some panic selling. And a lot of that will typically, when we have a major risk reversal on Wall Street, because Bitcoin has been one of the most profitable trades out there, you'll probably see, I think, some weakness. So I think at some point within the next few months, you'll have a decent pullback, maybe 10 or possibly 20%. But then I think ultimately the long-term bullish trend will reassert itself.
So Bitcoin recently has seemed rather immune to some of the factors that used to bring the price down. Like, for example, China, right? It used to be that there was a Chinese crackdown and it would sort of, temporarily really affect the price. It didn't really apply to China. Then we had this, so-called disastrous infrastructure bill, and Bitcoin obviously didn't care about that either. So, just aside from this, the inflation concerns that you mentioned, what are some factors that could potentially bring Bitcoin's price down? I mean, what could cause a correction in the market? Because the things that used to do it don't seem to really apply anymore.
Well, I think one of the bigger concerns was that we were going to have massive regulation with stablecoins, and I think there is some optimism growing that is not going to be the case. So I think that was kind of one of the key risks that were on the table. As far as exiting China, I mean, China has been trying to get rid of Bitcoin for many years now, and I think the market has fully been prepared that that is going to happen, and eventually the Chinese will make it illegal to hold Bitcoin. But I think now you've seen a successful migration away out of China, and there is tremendous interest still that is happening right now. I think as far as people reaching out to me that are diehard equities options traders, they're now getting into cryptos, and it's all been very recent. So I think there's still tremendous interest that's happening, and you're probably going to have, I think, more investors. They're going to look at it at the end of the year. It's going to be the third year in a row when you're having cryptos as the best performing asset, and people are going to have to ask themselves, why am I not investing a low single-digit percentage of my trading portfolio in it? And if you continue to see that progress, I think there is still tremendous upside, because relative to other markets, the crypto market is still relatively small.
I have to push back a little bit on this idea that there'll be profit taking before the end of the year, only because wouldn't a lot of these institutional players want to have essentially window dressing, right? We have the next inflation reports coming out a month from now. It'll be the last one of the year. For all we know, it could probably be just as hot as today's numbers were. Wouldn't it make sense for these guys to say, look, I need to have Bitcoin, I need to have other crypto in my portfolio now, because when December 31st comes, I want to show that I held it at a time when inflation is up. Wouldn't that actually bode fairly bullish for crypto rather than people taking profits? Isn't that going to outweigh any profit taking?
Well, I think you have to take a look at where people's expectations are with inflation. And right now, we've seen consecutive months of surging pricing pressures. And this was the first month where a lot of people were starting to pay attention to earnings season. And you were getting a lot of mixed messages from CEOs saying that, no, we're able to handle the pricing pressures. No, we're starting to see them moderate. So the transitory argument is actually still, I think, the playbook right now. And if you're Wall Street, and if you think that these pricing pressures are starting to ease, then you're going to have a major reaction on with every inflation hedge. So I think that you're probably going to have more cautiousness. I know this inflation report, it kind of catches your attention, 30-year high in prices. But I think there is a lot of traders that are anticipating that this is going to start to wane. And if that's the case, you're probably going to have, I think, a good amount of Wall Street is going to make that bet. And that's why I think you could see profit taking go into year end. Possibly that could be accelerated after the next inflation report.
We've had those several months of surprise inflation, and there is a change in attitude from a lot of people, at least institutionally, that hey, might not be transitory. This might have kind of overshot the expectations of what a rebound would look like. So I mean, at what point do we say, hey, you know what, the profit taking that could have happened already happened, and that going forward, if there's one more surprise number, it will come out in the middle of December. There might be some more enthusiasm for, or rather some more bullishness of inflation, if you will. So people will want to keep this at least till December 31st, just to show that they're on the ball with it. I mean, do we have any sense of how the institutions are actually playing this?
Well, I think you have to take a look at a lot of these institutions are underperforming the S&P 500, and that is one of the reasons why I think you're going to see profit taking. They're going to have to make up. They're going to have some profitable trades to close out the year to beat that performance, and they're going to lose investors if they're not outperforming the S&P 500. This has been a fairly one-way trade, and I think a lot of people were miscalculating the inflation trade, and I think that you're probably going to see there are a lot of people that are long-term betting Bitcoin. The whale alerts, you can see that a lot of that money is holding. They're not budging. They're looking to see Bitcoin above 100,000 before they might consider doing something. But I think a lot of this money is now becoming very active. And I think a lot of people are anticipating December is going to be one of the most volatile months of the year. So I think you have all this nervousness that's brewing. And I think right now, the trade right now on Wall Street is no one wants to touch fixed income. No one understands what is going to happen with the curve. Why is it flattening? How it's going to react after every inflation report or jobs report. And now you're probably going to see that volatility is going to be elevated. And I think right now, for a lot of people, they are looking at end of year results, and that's why you're going to see some take some profit off. And I think one of the things that you're also having to notice on Wall Street is that the interest isn't purely on Bitcoin and Ethereum. It's starting to spread into these other altcoins, and I think that is one of the things that's making the continued surge higher here for Bitcoin a little bit harder. I think the outlook is still bullish, but I think it's going to be a lot harder as investors are starting to embrace some of these other top blockchain cryptocurrencies, and you're probably going to see the market space is going to grow, and I think that's great for the cryptoverse. But I think the movement for Bitcoin, it's going to be a lot harder to go higher, and I think that diversification trade is going to remain in place.
All right, Edward. What I'm hearing is bullish in the long term, bearish sentiment, risk off in the short term. Thanks for joining us. That was Oanda Senior Market Analyst Edward Moya. Coming up, Congress passing a bipartisan infrastructure bill that poses challenges for U.S. miners. That discussion coming up with crypto mining advisor Foundry. $1.2 trillion bipartisan infrastructure bill awaits the signature of U.S. President Joe Biden. It contains controversial crypto tax provisions, despite alarm bells sounded by crypto lobbying groups. Joining us now is Mike Colyer, CEO of Foundry, a crypto mining advisory firm and sister company to CoinDesk under parent company Digital Currency Group. Hello there, Mike. Thanks for joining us. So one provision potentially within this infrastructure bill ropes in miners into the definition of brokers. And There is another one that also mentions digital assets would possibly require further reporting requirements for transactions exceeding $10,000. So crypto advocates have warned that this could be disastrous for mining. Is that true? How do you feel about it?
Yeah, it's a great question. I mean, I think there's a lot that needs to happen before that, becomes law. And there's a lot of folks that are working to make sure that they get the regulations right. And, being at Foundry, part of DCG, we're working, hand in hand with the industry to make sure that the regulations that they put forth make sense. And it's going to be interesting to see how it kind of plays out.
So, Mike, you're getting into involving institutions into proof of stake mining. So what institutions are doing this, and who are you targeting? And what exactly are they doing here?
Yeah, Lawrence, it's our mission at Foundry is to empower decentralized infrastructure, and we started the business focused on proof of work. We really helped the North American mining ecosystem bring more hash rate to North America. We launched a pool, which is now the largest pool outside of China for Bitcoin mining. And today we're announcing our Foundry staking business. So we support large institutions, banks, wallet providers, exchanges for staking services. So the other half of decentralized networking is proof of stake, and we think there's a lot of potential in these various networks.
So you mentioned You mentioned the likes of banks, et cetera. Is there a particular type of institution that has expressed interest in proof of stake mining, or are you just taking a shot in the dark here? And also, what kind of currencies have they expressed interest in doing a proof of stake mining?
Yeah, so we've been staking for the last probably 18 months now. We started with staking DCG assets. So we've got our own skin in the game. We work very closely with Genesis and their customer base. With these new protocols that are coming out, many hedge funds, venture capital firms are looking at investing in these assets. And you can invest in the asset, then you can also use those investments to help secure the network and earn rewards. And as they want to do that, they're going to want a trusted partner to work with. And in terms of other financial institutions out there, I think every financial institution in the world right now is looking at this digital asset ecosystem and trying to figure out how they're going to play. And as they start to navigate that process, they're going to want a trusted partner to work with. And I think that's what Foundry is going to be able to bring. When we started the company, Barry Silbert said, we want to build something for the next 10 to 20 years. We're going to be here through the thick and thin of the industry. And we've got, our own skin in the game. So we're going to be, I think, a really good option for folks.
So one of the most interesting crypto stories over the past year or so has been this shift from, China to the United States or to North America in mining, right? And you're clearly at the center of that shift. Can you just talk a little bit about, how this is playing out in the U.S.? Like, what are some of the states that are leading mining, or where do you see most of the mining going in the U.S.?
Yeah, so I think it's been amazing what has happened over the last 12 months, right? I mean, if you step back, if you think about the Bitcoin network, probably one of the biggest attacks on the Bitcoin network has been China shutting down mining. And it pretty much didn't skip a beat. It's really amazing how strong and decentralized the network is. And a lot of the hash rate is coming to North America. And we've seen a lot of mining companies be able to raise money on the public markets. The miners, are incentivized to go find the lowest cost energy. And that lowest cost energy typically is renewable energy. So they're going to the places where there's been a lot of new energy assets built. So places like Texas, the Midwest, any place where there's hydro, like the Tennessee Valley Authority is a big area for that. Upstate New York is a good area for it. So there's a lot of places where there's low cost power and infrastructure available, and miners are taking advantage of it.
So, as Christine mentioned early on, there's this provision in the infrastructure bill, which, if it became law, seems like it could be very problematic for mining in the U.S. And, one of the issues is that I don't think that Washington lawmakers or just the general public necessarily understands why the mining industry is good for the U.S. And I'm just curious, how you would articulate that argument. Like, if you were trying to argue to Washington, okay, here's why we want to attract mining to the U.S. Here's why it's actually good for the country. What would be some of the arguments that you would put forward?
Yeah, so we're spending a lot of time educating, right? So that's kind of the big focus for the next probably 6 months, is educating the folks that are representing us on this industry so that they understand kind of the decisions and the rules that they're trying to put in place and what the impact is. I think decentralized infrastructure is going to be critical to solving a lot of problems going forward. When we talk about giant tech monopolies and such, they're nervous about what decentralized infrastructure does for them, and I think this is going to be a great alternative for folks. Decentralized systems help level the playing field. It allows more people to be involved. It allows everyone to engage. If you want to mine Bitcoin and support the network, you can do it. It doesn't matter who you are. And I think that's such a huge, powerful concept that what we have found is when we speak to lawmakers about it and start to talk to them through how this process actually works, they actually get super excited about it. Like they want to know more. They start going down that Bitcoin rabbit hole, and they just want to learn. And it really is eye-opening, and it's exciting. And I think we're just at the very early stages of it.
So, Mike, you mentioned states like Tennessee, Texas, upstate New York. What kind of facilities do you purchase? Are you leasing? I'm asking on behalf of all my real estate friends who keep bugging me about, where should they invest in real estate? What as a miner, what are you doing in that regards? Like, are you purchasing facilities? Are you leasing them? Are they warehouses, converted office buildings? How does this work?
Yeah, so Lawrence, you start with where can you get low cost power, right? And then the big trend right now is mostly kind of greenfield operations where you're putting containers out there. On the staking side, the proof of stake side, it's a very different business where you're actually building infrastructure in the cloud or on bare metal in traditional data centers. At Foundry, we're building our own private Foundry cloud. So the staking works in a little different way than the proof of work mining side.
Mm-hmm. You mentioned that you're talking to institutions as well as folks and regulators, those policymakers in DC. ESG, environment, social governance, and the energy consumption of mining is often a talking point around when it comes to concerns around mining. So I wonder how you're addressing that. And is that a reason why you're moving toward proof of stake mining?
Christine, great question. So proof of stake, we empower decentralized infrastructure, right? And there's kind of two approaches, the proof of work, proof of stake. They're both going to exist. On the proof of work side, when the question comes up around, energy usage, look, at the end of the day, Bitcoin mining, the Bitcoin algorithm drives miners to the lowest cost. And I believe the lowest cost energy is renewable energy, and Bitcoin mining is actually a bridge to a future where we're going to have 100% renewable energy. We can't get there today without it. And as what we're seeing is the biggest energy companies in the world are starting to understand the power of a large base load that's intermittent, and they're going to be integrating it right into their infrastructure. They're doing it today. I mean, it's amazing what's happening. So on the proof of stake side, there's just there's a whole bunch of new protocols out there that solve different problems that are different than just like Bitcoin, right? Bitcoin's a great store of value. Someday it can be a currency. With the proof of stake side, they're solving lots of other problems, and they use a different method to make that happen. So we support both. We think both are going to exist for the future, and we're at the very beginning of a pretty exciting decentralized world.
And we're excited to see that journey. Mike, thanks for joining us, and congratulations on your new initiatives. That was Foundry CEO Mike Colyer. Time now to check in with Crypto Twitter with our tweet of the day. And this one from Morgan Harper, a candidate for U.S. Senate in Ohio. They have a Democratic primary scheduled in May. And she's deeply thinking about crypto's potential, tweeting cryptocurrencies are energizing a rush of attempts to try, referring to eliminating intermediaries and distributing economic power. There are crypto projects out there that want to compete with basically every facet of what a bank or social media company does. And their basic model is more inclusive than a corporation. I've heard anecdotes and seen some stats about how many young people and people of color use Bitcoin, which makes sense. Historically, we've been locked out of traditional forms of investment. I encourage you to go out there and read that tweet thread. All right, that's it for First Mover. Thank you, Emily Parker and Lawrence Lewitton. I'm your host, Christine Lee. I'll be back live at 3 p.m. with all about Bitcoin. And coming up at noon are the folks at The Hash. You're watching CoinDesk TV.